Good morning and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. I go by Blind Run on the internet and Matthew in real life. And we did get the mic moved over to the other side of the desk, so let me know if this works out a little bit better. And that is because we have been doing seated shows here for this week because I'm still a little under the weather. That being said, today we have, well, another show. And we got another bear market show, so it is what it is, right? Over 1.2 billion stolen from Ethereum-dominated crypto sector in Q1 of this year, says the FBI. The Federal Reserve has its real-time payment system available as early as May of 2023, so we're getting one more step closer to a United States-based CBDC or central bank digital currency, which is quite terrifying to some and, exciting to others. Let me know what you guys think. I'm more along the lines of, pro cryptocurrency, anti CBDC. Some people, maybe are pro CBDC, anti cryptocurrency. They really like fascism, I suppose. Just giving you guys a hard time. Next, we also have, can Ethereum out-engineer the sensors by shuddering the beacon chain? This is an opinion piece that I found extremely interesting, so we're going to hop into that. And Jim Cramer urges investors to avoid assets like Bitcoin. We are basically going into a recession. Technically are in a recession, just depending on, who you ask and who's changed the definition of a recession. Probably closer to a depression at this point. And, some people are saying, hop out of the markets, especially cryptocurrency. They say, get out now. So is the bottom in? We also have Bitcoin mining difficulty poised to spike by most since January. And of course, this is coming thanks to a bunch of colder weather. That being said, if you look at the cost of electricity across the Western Hemisphere, it is getting absolutely insane. And unless you are an electricity provider yourself, you aren't looking too good. In the UK, we are seeing insane price increases in, of course, the amount of power, electricity costs. And there is fear, of course, that it's getting so bad that we're not even worried about cryptocurrency mining over there, but just if people are going to be able to survive and live without getting their power shut off during the winter. And that's how bad it is getting in some places. And you need to pay attention because that means, of course, while colder weather is coming, that's great for miners. Cost of electricity is going way up, right? We have new upcoming node incentivization programs by miners of Kadenia, and this is essentially going to be in I guess, the works with Flux, so we'll be talking about that. And we have possible RTX 4070 specifications updates or specification updates specifically as it pertains to the memory. It looks like we are potentially getting GDDR6X memory as opposed to just GDDR6 memory. This would be a big deal for the 4070 because if it was going to be the traditional GDDR6, it was looking like pretty slow memory and it wasn't looking that great, to be honest. So this could be a little bit better. The 4080 and 4090, we were already seeing, some improvements as far as that is concerned. Still not looking quite on par with the previous generation from a memory perspective, but still looking a little bit better. We also have some pre-configured Flux nodes I wanted to shout out for, a fellow YouTuber here, if you guys want to check that out. And we got to talk about Helium and HIP 70, which is essentially, let's not run our own network and go to a different L1 chain. And the L1 chain we picked is Solana. Let's get into all of that and more after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. And welcome back, everybody. So first things first, let's just hop into it and get the elephant out of the room. HIP 70. You guys know I have not been a big fan of Helium. In fact, even when it was blowing up and everybody was like, why aren't you reviewing the Helium stuff? I was like, because I don't have a Helium device. And by the time I got a Helium device, it wasn't really worth anything. These kind of things that are kind of, I guess, blow up overnight. They get extremely popular. A whole bunch of people buy a whole bunch of hardware for it. It's really hard to get the hardware. And then by the time everybody gets their hardware, it's no longer profitable. That's pretty much what happened with Helium. Now, there were obviously other issues going on with Helium that we talked about in the past. They were very quick to change monetary policies that damaged the actual hardware infrastructure people compared to the holders. This is not dissimilar from what a lot of different networks and blockchains have done in the past too, which is reward the people that do the least amount of work and have the most amount of money, and damage the people that do the most amount of work and have the least amount of money, which is pretty much, you know, the way society works in general. As it is, it feels like sometimes, and you're kind of fighting a losing battle. That is how Helium functions, in my humble opinion. But in this HIP, they propose a new approach to proof of coverage and data transfer accounting by moving this responsibly to oracles and thereby reducing the complexity required for operating a blockchain that supports the Helium network. Through these actions, we believe we can allow for more reliable data transfer and more consistent and predictable proof of coverage activity. With the move to more oracled activity on chain, we believe that the simplification allows us to select a more scalable layer 1 for Helium community, specifically Solana. It is very weird to go from we're going to, you know, we want to have essentially a more scalable solution than what we have, which is our own layer 1 blockchain. We want something more reliable. And we're going to go to Solana, which has gone down over 7 times in the period of a year and has proven to not be very reliable. Yes, I suppose we could say Solana is scalable, at least compared to pretty much a lot of the other projects currently out. Sure, we can give them that. But reliable, it is definitely not, right? And that's kind of where I go, what is going on here? It does seem like, of course, with something like Helium that is a little bit more centralized in the way it's governed, they would go with a more centralized project like Solana and probably have some weird back dealings that basically is financially beneficial to both of these networks and the people that control them. Integration of the Helium tokens, HNT, DC, IoT, and mobile initially into the Solana ecosystem additionally provides Helium wallet holders access to a variety of applications, governance mechanisms, and other utilities not available natively on our sovereign L1. We acknowledge that this change removes the need for staked validators operating block production and challenge creation as they do today. That said, we expect that HNT stakers will migrate their positions towards securing current and or future sub-DAOs and participating in governance through the vote escrow token-based system proposed in HP 51, which you could check that one out as well too. Removal of the staked validator reward also returns the full 6.85% of HNT emissions back to the miner pool. That could be considered something positive for the miners, of course. Here is that there is that additional 6.85% that, since they're shutting down the staking, will go back to the miners technically. So the people that are running the actual infrastructure, that is a positive that comes out of all of this to a certain extent. The question is of course, how much does this impact the actual project and the price of HNT if HNT just becomes essentially a token on the Solana blockchain, which I believe is pretty much what's happening here, right? Including, of course, the DC, the IoT, and the mobile. All that stuff becomes basically just tokens on the Solana blockchain. So we consider these changes as complementary to the changes proposed in HIP 51, a necessary set of changes to more easily implement some of the redemption and governance mechanisms proposed in 51, 52, and 53. We additionally expect that more protocols will be attracted to participate in the Helium ecosystem because of the move to a more widely used layer 1 blockchain. And obviously that is kind of what they're going for, is more people to essentially hop into there. What do I see though? I see them messing once again with monetary policy. And this really makes it difficult, I think, for, stakeholders, for people that participate in the network. If you keep messing with the monetary policy, it's like, I don't know. At the end of the day, like, are you smart enough to be running a blockchain project in the first place? I suppose is how I set that out. You guys know that I've had these issues with other networks in the past where it's like, if you're supposed to be a really good coder and really good at math, then why do you fail to set up a proper monetary policy from the get-go, right? Why do you have this problem from the very beginning? Now, this could be a little bit different, of course. It's not just monetary policy. They are changing monetary policy as a result, but at the end of the day, what they're trying to do is scale it out with another project, essentially with Solana. I think that Solana is a weird choice because I don't think it's very reliable. I think changing the monetary policy is going to upset the current stakeholders potentially. And I'm not sure that any of this is really good for the network. I'd like to hear your thoughts and opinions, of course, in the live chat as well as the comment section down below. Let's go ahead and talk about a buddy here, DJ Mines, guys. He has released he's being an entrepreneur, all right? He is setting up Flux nodes for you, and you can go purchase them. This isn't typically something I would shout out or anything along those lines, but I support DJ Mines. I want to make sure that I support, fellow content creators, entrepreneurs, all that sort of stuff. I trust that he will ship you the item. So he has basically a web front store here at fluxnodestore.com. You can come over here and purchase a Cumulus box already pre-configured and ready to go, or a Nimbus box already pre-configured and ready to go, and plug it in and have your own Cumulus or Nimbus node that will be earning you passive income. If that's something that you're interested in and you didn't want to build your own, this is an option. And it's from a super awesome guy, DJ Mines, so definitely go check it out. It does look like he's using HP and Dell little boxes there, kind of similar to what we used to use in IT for, like, I don't know, nursing desks and so on. I forget what they call them now at this point. I'm blanking. It's okay. So the RTX 4070, the memory specifications are looking better as we get closer and closer to the release and the launch of the Ada Lovelace series. This one in particular is now saying that we are getting 12 gigabytes of GDDR6X memory with a 285 watt TGP. Now, in particular, this does mean that we are getting a faster memory speed than we were getting on the 3070. However, if we scroll down and take a look at the presumed size of the bus, it does look like we are still seeing a pretty tiny bus. And you guys know I like big buses, and I cannot lie, tiny buses bother me. They can't handle the throughput and the pressure and the amount of hash that we would prefer. But 192-bit bus, but we do get faster memory. On the 4080 and 4090, we were really looking at something like 24 gigabits per second. It looks like this will get the downclock GDDR6X so far from what we're seeing here at 21 gigabits per second. And it will be probably one of two variants depending It looks like here that we're going to have a 4070 with a 160-bit bus interface and a 4070 Ti with a 192-bit bus interface. Of course, the 4070 itself looks to be 10 gigabytes of GDDR6X instead of the 12 gigabytes, and it has a cut down memory bus. What does this mean for memory bandwidth, which is what we're interested in? And that does mean on the 4070, we would only have 420 gigabytes a second of memory bandwidth, which comes in actually lower than the RTX 3070, which has 448 gigabits per second. And that is actually still on GDDR6 without the X, which is only 14 gigabits per second. And as you can see here, what does that mean? It means that the memory runs cooler though. So not only is it faster, but the memory runs cooler. If we bump over to the 4070 Ti, we get over 500 gigabytes per second, right? And awesome. So there you go. But compared to the 3070 Ti, that's 100 less, right? And so it's kind of odd. Now, technically, it does look like the 4070 Ti might come in at a lower power consumption than the 3070 Ti does, but with the cut down amount of memory performance, I'm just not really seeing a benefit here. Hopefully, something changes for these GPUs, because right now they're not looking terribly great for mining. Of course, the place where they could end up excelling is going to be from the core perspective, because we are expecting huge core improvements, and that could mean things like Caspa, for example, Flux, Ravencoin could get benefits from that perspective, but we're gonna have to wait and see once these things actually launch and are in the hands of the public. Now, new upcoming node incentivization program by Miners of Kadenia, and this one's interesting. This is Flux and Miners of Kadenia, which is MOK for short, and they are the very first GameFi projects to be building on the Kadenia blockchain, with the focus of on creating a gamified gateway to the Kadenia ecosystem as a whole. Their goal is to bridge elements of DeFi and NFTs into one protocol to solve many of the problems currently existing in crypto, like high entry barriers and lack of real utility. Like Flux, MOK has the ethos of decentralization by birth, so they saw the great value that our decentralized cloud infrastructure can provide for them. They took action and have recently announced their plan to be the first GameFi project to exclusively use the decentralized cloud infrastructure of Flux. Throughout their early conversations, they disclosed their sympathy for their current successful incentive program that we have been running with Kadenia LLC from early on. They saw the value of extensive relationship between Flux and Kadenia and the awareness that bore fruit from it, and decided to step foot into the program themselves. Miners of Kadenia, I think it's pronounced like that, or Kadenia, have reserved a total of 1% for their total supply to the incentive of the node operators who support their infrastructure with computational resources. The node structure focuses on incentivizing node operators that support the chain web infrastructure. MOK decided to follow a slightly different route to adapt to its current infrastructure needs. Besides rewarding the chain web infrastructure backbone only, they will moreover reward node operators who are supporting their front end application. Forward-looking news for the Cumulus node operators: for the time being, they missed out on additional rewards due to not being the minimum required computational resources. Due to playing a major role in regard to the total computational resources available, it was fundamental for MOK to include them in their reward program moving forward. After internal discussion, they decided to split the total distribution of MOK tokens between Chainweb and front-end node operators by 80% to 20%. Further diversification is taking place in the Chainweb distribution model itself, which closely follows the current Kadenia node structure. So as far as details go, qualifying applications, you guys can go through all of this. The distribution model, front-end infrastructure, monthly allocations, all of that, and get some more information. This is a project I haven't really gotten to dive deep into. I wanted to bring it to y'all's attention though. Also, what do you guys think about Kadenia? I mean, isn't it kind of weird that they're an LLC? I don't know. Anyways, Let's talk about Bitcoin mining. And Bitcoin mining difficulty poised to spike by most since January amid colder weather. So analysts are saying essentially, we're finally getting out of the summer. It's been hot as can be. And with the cooler weather coming in, we should see a trend in, of course, the hash rate of Bitcoin going up and the difficulty, of course, in turn going up. This is something I would expect too, especially with all of the Bitcoin miners that have been moving into the Texas region here recently. It's been pretty difficult for a lot of them to run. Some analysts are starting to see this as a start of a new seasonal trend in Bitcoin mining. The difficulty of Bitcoin mining is expected to grow by around 9% on Wednesday as miners in North America begin ramping up production ahead of the cooler months. It will be one of the biggest upticks since August of 2021 when miners began to come back online after the industry was banned in China, which at the time was home to 44% of mining activity. Bitcoin's difficulty adjusts automatically to keep the time required to mine a Bitcoin block at roughly around 10 minutes, depending on the amount of computing power on the network. The higher the hash rate, a measure of computing power, the higher the difficulty. Similarly, as hash rate drops, so does the difficulty level. So far this year, the network difficulty's highest increase was in January at 9.32%. This time, the metric will grow by around 9% to reach around 31 trillion, according to estimates from BitRAR, CoinWars, and Luxor's hash rate index. That's very close to the metric's all-time high of 31.25 trillion on May 5th, according to data from miningpoolbtc.com. Analysts speak to CoinDesk agreed the uptick in the hash rate and difficulty are a result of more and newer machines coming online, as well as the waning impact of heat waves. The post-summer network hash rate boom is a result of more efficient hardware being delivered, summer temperatures falling in the US, and old generation machines being delivered to low-cost region, said Ethan Vera, Chief Operating Officer at mining services firm Luxor. The hash rate of the Bitcoin network dropped in mid-July as miners in North America powered down during heat waves that swept through the continent. Besides requiring a large amount of energy to run their computers, mining rigs produce a lot of heat during their operation, which means companies need even more energy to cool them down. But during these same hours, demand for energy across the grid also spikes, and people and businesses turn on their air conditioners. In some energy markets, miners can sell power back to the grid, thereby making more money by turning off the machines than they would by earning crypto. Some industry insiders, including Vera of Luxor, say that they could be seeing a start of a new seasonal trend in Bitcoin mining. Prior to China's ban on the industry in May of 2021, the hash rate would increase during the rainy season in Sichuan from May to October, when miners in the country would take advantage of low-cost hydroelectricity. As many miners have since moved to Texas, bumping their energy consumption in the state by about 1.5 gigawatts, where temperatures run hot in the summer, the opposite trend might emerge. Network difficulty drops in the summer months, with sharp increases occurring in the fall and winter months as miners come back online, Galaxy Digital wrote in its mid-year mining report released last week. And that makes a lot of sense. Obviously, I've been dealing with a lot of heat. If you guys haven't seen, even hitting as high as 54 degrees Celsius on the intake temperatures of the Octo miners. By the way, make sure you guys go check out Octo Miners 3 via the affiliate link down in the description below, because thanks to them for helping me get through the summer months, which has been super helpful. But that does mean our hash rate is down. Whereas, we're typically sitting around 6 gigahash a second. We're sitting around, 4.5 to 5 gigahash a second. And that is just frankly due to the amount of heat. We'll get back closer to that 6 gigahash a second. We'll consume less power and we will have just better temperatures as we get into the winter months. And that does bode well for us. Of course, we're getting this whole wrench thrown into the freaking plan as it goes into the merge for Ethereum, which should be interesting, that we'll be dealing with here this coming month. Of course, last day of August right now. We have about a week left before we see the Bellatrix upgrade on Ethereum. And then from there, we have about another week or even less half a week to a week, 4 days to 10 days, somewhere around there before we see the final move. And then we'll have to see what is left over of the remaining networks to provide, of course, all that revenue that Ethereum to date has been providing all of the miners. Hopefully what we're expecting and we hope to see as GPU miners is the majority of these guys on Ethereum are running ASICs and they just blow up the ETC network and we're fine on our Ergos and our Fluxes and such. Now that could be true, that could not be true, because we are aware, of course, of HUT 8 who do have, basically some sort of cheater GPU that they work directly with NVIDIA to obtain a bunch of. So they have those. But HUT 8 has also been talking about essentially changing into a data center setup with high-powered computing as their main kind of move post-merge. Is that true? We'll have to see what happens to the networks, because I really couldn't tell you. Now, I can tell you that moving from, a mining rig in particular into a high-powered computing rig for data center processing is not a cheap task, as opposed to just having your even expensive, admittedly, octo miners, which are going to run you $800 to $1,100 a piece. Of course, a little bit cheaper if you're buying in bulk like they would presumably be doing. That's still a hell of a lot cheaper than purchasing a server that will do by 16 on these GPUs for high-powered computing and data center processing. So, plus, those servers that you're going to be purchasing to actually facilitate that are going to be not only extremely more expensive, but going to run fewer cards per unit. You're not going to be putting in by 12 GPUs. I think for the most part, you're looking at 6 to 8 in those. And that was back in the day when I was doing them for, whatever, like usually it would be for architecture firms, that sort of thing, where you would set it up as some sort of in-house processing. So I have built a few of those, but those are expensive systems, and I don't know that they are ready to actually make that full transition. So that's kind of the question that I have surrounding it. So simultaneously, though, in the last month, new technology has been deployed across facilities. A lot of machines have come online in the last month, increasing Bitcoin's 7-day average hash rate from 210 exahash a second to 226 exahash a second, a 7.6% increase. This increase comes from miners plugging in new models like the S19 XP, which miners began receiving in batches starting in July, said Colin Harper, head of research and content at Luxor Technologies. However, older generation machines coming online in other countries also increased the hash rate. When Bitcoin pricing fell in the second quarter of this year, many miners in North America and Northern Europe unplugged their mid-generation machines. They began the shipping process to low-cost regions such as Venezuela, and those machines are starting to get plugged in, Vera said. As more of the newer generation machines come online, the trend will likely continue, said Kevin Zhang, Senior Vice President of Mining Strategy at Foundry, a company also owned by CoinDesk's parent firm, Digital Currency Group. So newer machines coming online, like the Antminer S19 XP with more hash rate, and of course the reduction of heat out in the environment means that you end up in a position where we will have more hash rate on the network. This will obviously be interesting as well on the GPU side of things when we start to have kind of the heat alleviated, but in combination, unfortunately, with the merge. So more hash rate on the networks, right? More potential hash rate, I should say, but no Ethereum, less money essentially to go out to the miners. What is this going to turn into? How much price discovery are we going to see? What coins are going to experience the price discovery, and how long does that take? Eventually it shakes out, right? Because all markets will shake out. If you can hold on to your equipment, my assumption is still you hold on to your equipment until it shooken out and everybody sells or capitulates and gets rid of a lot of their equipment, and then you can capitalize on that and then turn your machines back on and basically have some sort of profitability. I think places where you're going to be extremely hard pressed to make money early on is going to be like Ethereum Classic, where pretty much if you have an ASIC, you have to go to Ethereum Classic. And as we've seen with the ASIC miners, they are really, really, accepting of the fact that they are going to have low margins. And they are already pushing the margins extremely low. The selling pressure on Ethereum Classic is very high. And I don't know that we see that changing anytime soon. So we have, changed the definitions of what inflation is. And that means, I guess, supposedly we're not, or a recession, excuse me. That means that we're basically not in a recession right now, according to at least Wikipedia. And, Joe Biden, does that mean we're not in one? I don't know. To me, it seems pretty difficult to be buying regular things, like groceries, like energy, right, to power the houses, and like gas. Energy in general, right, is seeming to be like the worst spot to be in. And so going into this, a lot of people, there's going to be the people that'll tell you this is the time to invest and this is where opportunities are. And then there'll be the people that'll tell you, no, it's time to get out, be careful. And Jim Cramer is now urging investors to avoid assets like Bitcoin. The cryptoverse has fetched a lot of critics since the very beginning. An array of officials spoke about how Bitcoin was the currency of the dark web. However, over time, Bitcoin proved to be much more than its association with the dark side of the internet. In the meantime, some warmed up to the industry, while a few others stayed dubious. The host of CNBC's Mad Money, Jim Cramer, has been quite vocal about his love-hate relationship with crypto. Bringing out the latter, Cramer urged the community to stay away from the speculative assets like crypto. The turbulence in the crypto market has already shaken an array of people. The recent carnage that pushed Bitcoin below 20K came as a shock to many. While investors were yet to recover from it, Cramer warned them to stay away from the industry. He went on to link to the current tightening cycle of the Federal Reserve. Last week's Fed Chairman Jerome Powell noted that they have been trying to bring down inflation. In the meantime, he alerted American businesses and households that there would be some pain during the process. He added, "Look, Fed Chief Jay Powell told us that we need to stop doing stupid things with our money." That was the thrust of his speech on Friday. I don't agree with that, though, because what he's saying is essentially they're going to be up or hiking, bringing down inflation and hiking up, of course, interest rates. And this is where, I think we're getting close to the pavement or the rubber meets the road, right? So what do I mean by that? We've talked about Bitcoin in the past for a long time about being a hedge against inflation. And yes, it's been following the larger markets. But we have also been in a position where, what's predicted at the end of the day would be that Bitcoin would be at this price level, regardless of what's going on in the rest of the markets. Meaning that basically due to the halving cycle nature of Bitcoin, this is pretty much where it's expected to be at, regardless of, if the economy is doing good or not. What they're trying to do is prepare you essentially for being in a position where you are going to be poor, I think, at this time. And I think even things like Jay Powell and so on will encourage you. Jay Powell, I like that. Mr. Jerome Powell will encourage you to pull all of your money out of the markets, because if your money's in the markets, your money is not necessarily protected, right? But it is tied to a different asset that is not what the federal government can control, or, the Fed can control in general. The way they can control it right now is adjusting interest rates, printing more money, that sort of thing. So if you hold US dollar, you are more likely to help contribute to however they are fixing the situation, right? So if they can manipulate that a little bit better. If you're holding something like Bitcoin, they can't manipulate that to the extent that they can, the US dollar. And Mr. Jim Cramer seems to be on board. In addition to these businesses and households, investments in crypto would also endure some pain, Cramer noted. And I think that that is true. I think that it's going to be very difficult over the next year. However, he also believed that the world wouldn't see the end of the decline until we get a giant washout of all things that are speculative. While he did stress on cryptocurrencies, he pointed out that it wasn't limited to them. Alongside crypto, he wanted investors to stay wary of companies that went public either through special purpose acquisition companies, SPAC, or meme stocks. He further said, what matters is that we just have to get through it intact. Don't get memed, don't get SPAC'd, and don't get cryptoed. And you'll get through this thicket and find yourself in a much better time when we are sufficiently oversold for a huge bounce. Amidst all of this, Bitcoin managed to reclaim 20K as it sits at 2405. Of course, right now, I believe we're actually lower than that at 19,981 right now. Anytime I've seen essentially basically a majority of the population go in one direction, typically you want to go in the opposite direction. That's what I've seen as far as like capitalizing on opportunity. I do think that cryptocurrency offers the greatest opportunity currently in our lifetime, and I think that it still is there. I think it's still very early. I do think that there's going to be a lot of projects that people get burned on. I think that there's going to be a huge amount of regulation surrounding it. I think that it's going to be a very bumpy ride, but I think it offers the most amount of opportunity. Of course, you can't invest more than you can lose, obviously, and that can be a dangerous position to be in. But at some point, it does get to the point to where it's moot, because if you are middle class or lower class, you're going to probably be broke and eating crickets out of a bag anyways. So there you go. But can Ethereum out-engineer the censors by shuddering the beacon chain? Ethereum developers are realizing censorship is not a problem that can be just coded away. In the previous edition of Valid Points newsletter, we drove headfirst into the debate around censorship on Ethereum. We've been talking about this a lot on the channel as well. We focused on the role that validators, the computers that propose blocks of transactions on Ethereum's upcoming proof-of-stake network, might play in censoring transactions. The censorship debate sprang up in response to the recent U.S. sanctions against Tornado Cash, the Ethereum mixer program used by money launderers and everyday Ethereum users to send and receive money without leaving a clear trail. In light of the concerns that Ethereum's transactions might be censored, members of the Ethereum community have been discussing ways the core protocol can be engineered to make censorship difficult or even impossible. One of the more compelling ideas for how this might work is a shutterized beacon chain, a proposal that encrypts key transaction details so they cannot be censored by validators. But Martin Kopelman, the creator of this idea, isn't so sure that censorship is a problem that the Ethereum community can code its way out of. For a community used to engineering its way out of and into problems, this may be a hard pill to swallow. The fear 2 weeks ago was that major validators such as Coinbase and Kraken might censor transactions in accordance with the U.S. Treasury Department sanctions. This potential for censorship was all the more worrisome given the few validators' control of majority of the stake on Ethereum's soon-to-arrive proof-of-stake network. And it gets even crazier too when we start talking about the distribution of the nodes across cloud infrastructure, where, like we talked about yesterday, essentially we have the potential for way over 50% of the nodes being run on AWS, and thereby pretty much giving AWS the ability to censor Ethereum transactions just based on them controlling the infrastructure. And there is no way to compete with cloud infrastructure the size of AWS at this time. And so if you really want to remain decentralized and remove censorship as a whole, I think that you have to be proof of work. I don't think that there's any really way around that at the end of the day. And preferably even proof of work without ASICs too, right? On the positive side, for those opposed to censorship, Coinbase and other big name validators have clarified their position on how they will handle sanctioned transactions. Most, but not all responsive have echoed that of Coinbase CEO Brian Armstrong, who said he would sooner end his company's staking business than succumb to censorship. And here's the thing is I don't necessarily believe him. Right? Like we've seen what Coinbase has done in the past as far as, setting up organizations to provide tracking services to the federal government. So I think that they're full of shit. I think that he is lying and he's just saying that because that's the best PR move right now. But when the rubber meets the road and the federal government is asking them to sanction, I for sure think Brian Armstrong will flip on you and decide to participate in sanctioning and censorship. Hands down, believe it 100%. I do not think that what he is saying here is more than anything but a PR move at this current time. And that is proven from his track record in the past and what they have been doing. So don't believe him. But on the negative side, a whole new set of questions has cropped up around whether transactions can be blocked before they are even sent by validators. These challenges center around MEV Boost, a piece of middleware that most validators are expected to use come the merge. Now, we've talked about MEV Boost in the past. One of the things I've said too in the past, way back, is that MEV is a much larger problem than even moving to proof of stake, right? And MEV is only... the MEV boost is problems are only exacerbated by the move to proof of stake, right? Which used to be here's the thing that's funny is it used to be called maximal extracted value, which now it's going to be called again. But then when it was getting negative connotations surrounding it, they changed it to miner extracted value, which to be fair, it kind of was because the miners were ordering the transactions. This is how this works. MEV Boost means that the miners have some sort of control over ordering transactions and can get additional payouts due to that. But now it's going back to being rebranded as maximal extracted value because miners will no longer be on the network. But before we continue, we'll need to explain one of the critical challenges plaguing Ethereum and other blockchain networks, MEV. When an Ethereum user issues a transaction, it's not automatically accepted by the rest of the network. First, it goes into the so-called mempool, a giant bucket of unconfirmed transactions from Ethereum users. Recall that a block is just a glorified list of transactions. Validators scan, select, and organize mempool transactions into blocks, and they propose out of the wider network. If they're clever, they'll do this in a way that extracts a bit of extra profit for themselves, a concept called maximal or miner extractable value, or MEV. Validators aren't the only actors squeezing out MEV. So-called searchers have also emerged, computers that scan the mempool and preview what transactions are upcoming. They then bribe validators by issuing transactions with a higher fee or tip to include their own transactions ahead of others that they expect to impact the market. MEV practices range from benign to malicious. On the more malicious end, searchers and validators can use their future-telling abilities to screw over the other market participants. Take sandwich attacks, for example, and we've talked about this in detail last year, by the way. I think there's a whole video I have dedicated on it if you want more detail. But say a searcher sees in the mempool that Bob is about to buy a bunch of DAI on a particular exchange. The searcher knows that Bob's transaction will increase the price of DAI, so the searcher buys up a bunch of DAI for itself right before Bob does. Then, after Bob pumps the price of DAI, the searcher dumps the DAI tokens that is just bought while the price was lower. The searcher, if they are clever, will net out with a profit. Bob, on the other hand, will probably pay a bit extra for the DAI as a result of the searcher's initial purchase. No fun. MEV Boost makes a bet that MEV, if it can be exterminated, can at least be more equitable if it can't be exterminated. Flashbots, its creator, achieves this by separating the actors who build blocks from the validators who propose them out to the wider Ethereum network. Builders, not validators, do the complicated optimization work of selecting and ordering transactions into blocks in a way that maximizes MEV. If everyone uses MEV Boost, the thinking goes, then at least everyone will have a fair shot at extracting MEV. Proposer-builder separation will eventually be baked into Ethereum's core code, but MEV Boost is a stopgap solution. To make things work, it relies on centralized relays to send blocks from builders to proposers. And this is where the whole issue of censorship comes into play. And we've talked about this before, but hopefully this is actually laying it out pretty good. Flashbots say that its own relay, the default relay that will be shipped with MEV Boost, will censor transactions in accordance with Tornado Cash sanctions. So what you essentially have is the position in that MEV Boost, which is the most widely used, is going to participate in sanctions with Tornado Cash. Yes, this isn't Ethereum itself, but it is a major player within Ethereum and pretty much how Ethereum functions, and is integrated into a ton of different applications on Ethereum, meaning that just one developer's actions here with Flashbots affects the entire network. It's pretty rough. Unsurprisingly, the wider Ethereum community was not happy to hear this. In response to community backlash, the team opted to make open source its relay software earlier than originally planned. This means other parties will be able to set up non-censoring relays when MEV Boost launches. Validators will have the option of selecting whether they want to use the censored or uncensored relay option. Even though uncensored relays will be optional, that's all they'll be, optional. For anti-censorship hardliners, which includes many Ethereum core developers, this is not enough. With all this controversy around censoring validators, relays, and software providers emerges a key question. What if censorship could be engineered out of existence? In a world where trustlessness is a core tenet, such as a utopian ideal becomes appealing. Enter shutterized beacon chain. In a research proposal this past March, authors framed the shutterized beacon chain concept as a way to solve the MEV problem. The proposal introduced a new Ethereum transactions that are encrypted when they go to the mempool. Outside of limited information like the tip that a transaction includes for validators to ensure it gets added to a block, other core details like who is sending the transaction, who is on the receiving end, and the quantity of tokens changing hands are hidden from searchers and block builders. Only after a transaction is approved and confirmed on chain will its content become unencrypted. The idea was originally proposed by Martin Kopelman, the founder of Gnosis Chain. The concept of a shutterized beacon chain in general is that we separate transaction inclusion from transaction execution, he explained to CoinDesk. So you have a period where you blindly include transactions purely based on whether they are paying a fee and whether they are paying a high enough fee. If they do, they should be included, and that's it. It's obvious why this might be useful from an anti-MEV perspective. If block builders and searchers can't see transactions payloads, meaning what is being paid to whom, then they won't have the information they need to extract MEV. How can you front run a transaction if you don't know what it contains? And that's awesome, in my humble opinion. As a side effect, shutterization could play a major role in preventing censorship. Validators and relays won't know whether to censor a transaction if they can't see its sender or recipient. Perfect. We won't dive too deeply into the underlying mechanics of the shutterized beacon chain concept in this newsletter. Beyond being complicated, the idea hasn't yet been fully flushed out and out on an engineering level. So not so fast. Kopelman says the shutterized beacon chain concept didn't gain much attention when it was introduced in March. Partly he thinks it was because MEV extractors, which account for a large portion of the Ethereum community, have profited handsomely from Ethereum's unencrypted status quo. And that is kind of what I was wondering at this point, because you're going to have those, essentially your validators and the people that are highly invested in Ethereum do profit pretty heavily off of MEV. And if your governance is going to be surrounded by people that profit off of a certain thing, getting rid of that certain thing is probably not going to be extremely popular. And the thing is they would rather have centralization and censorship and make more money than they would want to have a censorless and fair network, right? And removing MEV will remove a huge portion of the profits of a lot of people that are going to end up validating the network here coming up soon. When Kopelman repitched the idea around censorship after August's Tornado Cash sanctions, though it was received warmly by members of the Ethereum developer community, some even took the idea further, suggesting that all transactions be shutterized, rather than making it optional as suggested in the original proposal. But questions remain. What if governments decide that processing transactions containing sanctioned addresses is illegal, regardless of whether the transactions were encrypted when they were picked up by validators? Or what if regulators decide to treat shutterization like Tornado Cash, outlawing a shutterized beacon chain entirely? Despite the recent enthusiasm around this idea, Kopelman noted in his conversation with CoinDesk that it is not as if shutterization or any engineering intervention can ultimately solve Ethereum's censorship problem. I think it's almost always possible, whatever the regulatory challenge is, to find an engineering solution. However, I also think that if you always try to find an engineering solution to it, at the end, Ethereum and crypto will become extremely niche, Kopelman told CoinDesk. And, you know, I think that that's an interesting concept, which is to adhere to the principles of crypto, or as closely to the principles of crypto as possible. You have to consider the fact that it won't be widely adopted. So we've always talked about this kind of concept between like adoption and principles. And I think it's one of the most difficult conversations to actually have within cryptocurrency. I mean, this starts with something as simple as a centralized exchange versus holding your own keys, and the barrier to entry that sets for retail and the adoption rate. And that goes over and applies to stuff like this. If, you know, Ethereum or any other cryptocurrency is outside of regulatory, you know, outside of the regulatory arm of different governments, you end up in a position where it won't be as widely adopted, because at the end of the day, frankly, people don't have any balls and they're scared to death of their own governments. And that's where we sit, right? Because if that wasn't the case, a lot less people would be paying taxes at this point. So don't tell me that people aren't scared of the government, because that is exactly what is going on. And if you have basically the government coming down and putting regulations on and surrounding crypto, people will just be too scared to participate in it, and you'll reduce adoption. And if cryptocurrency projects are going to try to adhere to the principles of cryptocurrency and basically push back on censorship, etc., from regulatory bodies, they will end up putting themselves into, of course, that cyberpunk niche. And that is where it will live for the time being. There has to be some sort of weird balance between, of course, the principles of crypto and adoption, and getting past that hump is going to be extremely difficult. When we talk about, you know, things like Jerome Powell saying things are going to get really difficult right here really soon, I don't think that just applies to the economy and to inflation and to rising energy costs. I think that also basically applies to the relationship between nation states and governments and their people. And I think that it's obviously with things like, you know, the president of the United States coming out against an entire group of people based on their political affiliation and basically challenging them to attack, and he'll use F-15s against them like he did yesterday and last night. It is very clear that the nation states and the governments see their people as an enemy, not as somebody to protect and take care of and provide for, which means that we have everything backwards now, and we are in a position where things are going to be more difficult. But that's okay, because if they regulate, you can go ahead and utilize their currency or their payment systems. The Federal Reserve says real-time payment system could begin as early as May of 2023. The FedNow system is supposed to be a cheaper option than wire transfers and debit card transaction fees. A Federal Reserve official said the agency's new real-time payment system, FedNow, is slated to launch as early as May 2023. FedNow has been in development for around a decade and is supposed to allow banks to send payments to each other in real time, thus allowing bank customers to send real-time payments to each other as well. The system will operate 24 hours a day, 7 days a week, and is expected to be less expensive than wire transfer or debit card transaction fees. But while FedNow has been in development, other banks and cryptocurrency industry have been looking for alternatives for real-time payments. The banking industry owns ZIL, a service payment that allows people to send real-time payments, and other applicants allowing real-time payments are basically like Venmo, Cash App, and PayPal are widely used by individuals. Fed Vice Chair Lael Brainerd said Monday to a FedNow early adopter workshop in Rosemont, Illinois, that she predicts the system to go live between May and July of 2023. This is very quick because what FedNow will eventually probably turn into is powering, of course, the central bank digital currency in the United States. So pay attention to this. This is happening very, very quickly compared to what I would initially have anticipated. And that doesn't mean that we're obviously looking at the digital dollar yet. This is a payment system, but this would be in line with that in general, right? Having the capacity to manage money in real time could help households avoid costly late payment fees or free up working capital for small businesses to finance growth, Brainerd said. Indeed, during the pandemic, we witnessed how essential rapid access to funds can be, as many households started spending emergency relief payments on the day they were received. And what is that, right? Like, this is a very important statement too to pay attention to, because what they're saying is essentially like, we need to have this fast payment system so that we can send relief payments to people in the case that we go through something like a pandemic or we decide to shut down and lock down the economy. And this does put, once again, it kind of puts that control back into the hands of the federal government, whereas they will be basically handling all of the payment systems, etc. And that can be a slippery slope. We'll have to see where this goes. I'd like to hear your thoughts and opinions on FedNow. Does that have the potential to turn into a central bank digital currency? And are you okay with that, or are you a little apprehensive as far as that goes? What would you think about the doing away with cash system? Over $1.2 billion stolen from Ethereum-dominated cryptos in Q1 of this year, says the FBI. The U.S. Federal Bureau of Investigation says that one popular niche of the cryptocurrency ecosystem has become a prime target for cyber criminals. In a new press release, the agency reports that users of decentralized finance suffered over $1 billion in losses during the first quarter of the year due to malicious online actors. Between January and March of 2022, cybercriminals stole $1.3 billion in cryptocurrencies, almost 90% of which was stolen from DeFi platforms, according to the U.S. blockchain analysis firm Chainalysis. The announcement said that tech-savvy criminals are taking advantage of vulnerabilities within the structure of DeFi platforms to fleece unwitting crypto traders. Obviously, we've been seeing this problem quite a bit. The FBI reveals several methods which the cyber criminals employed, initiating a flash loan that triggered an exploit in the DeFi platform's smart contracts, causing investors and project developers to lose approximately $3 million in cryptocurrency as a result of the theft. Now, obviously, that is also related to the MEV problem we were just talking about too. Exploiting a signature verification vulnerability in DeFi platforms, Token Bridge, and withdrawing of or all of the platform's investments, resulting in approximately $320 million in losses. And manipulating cryptocurrency price pairs by exploiting a series of vulnerabilities, including DeFi platforms' use of single price Oracle, and then conducting leverage trades that bypass slippage checks and benefited from price calculation errors to steal approximately $35 billion in cryptocurrencies. The agency goes on to make several recommendations about how DeFi users can avoid getting scammed, including researching whether a platform has conducted a code audit, skepticism towards investment pools, which set brief funding windows, and wariness towards platforms which rely on open source code contributions. The report also encourages DeFi platforms to enhance security measures and develop vigilant threat response plans. At the time of writing, DeFi subsector has a total value locked of nearly $60 billion, and over 57% of the capital, $34.22 billion, reside on Ethereum alone. And this is kind of one of those things that we have to keep pointing out too. The elephant in the room is that of all the DeFi projects, over half of them are on Ethereum. And this does mean from the mining perspective that if half of the DeFi projects, which is kind of like one of, if not the largest thing going on in crypto right now, second to maybe NFTs potentially, right? Which Ethereum has most of the NFTs as well. The impact of revenue generated from mining will be significantly impacted once we go through the merge. This is just something that is inevitable at the end of the day. And if you wanted to say that I hope that Ethereum takes a dump when it goes through the merge because you have some sort of personal vendetta because they are moving off of proof of work, you have to keep in mind that that's going to affect the entire market, right? Because this is billions upon billions of dollars with over 57% of DeFi being powered by Ethereum, that if Ethereum takes an absolute the entire crypto market takes an absolute. And that is just frankly how it goes. So I wouldn't wish harm on Ethereum at this point, but I would be very cautious surrounding them, especially like for all the reasons that we talk about, including not only MEV at this point and censorship issues, as well as the amount of nodes that are run on AWS, but just the fact that you can't even withdraw the staked Ethereum post-merge. There are a lot of things that spell out bad news for Ethereum right now, and unfortunately that means spelling out bad news for the entire cryptocurrency market as a whole, and that is how I see it. Yes, I get it. You can say I throw FUD around, you can say all of those things, but I'm being realistic and I'm being completely honest with you guys when we look at this completely objectively. And if you have a difference of opinion, I'd love to hear it, of course, in the comment section as well as the live chat. So let's get into mining profitability for the day right after a word from today's sponsor. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. Alrighty, and welcome back everybody. So to be completely frank, we had a couple rigs go down apparently last night. I was trying to work on them. I only got one up today so far, and the profitability is kind of terrible. The average over the past 24 hours, 4.21 gigahash a second, which put us at 0.061 ETH, and that is 91.71 for the day. Not really covering, all the costs that we have going on, unfortunately. And then the expected earnings is 0.056, which is going to be 84.15. Once again, not really quite covering, unfortunately, even running up to the merge, not covering our costs. That is where I'm at though. It is what it is, and this is the game we play for now. That being said, we can take a look at what to mine and calculate the RTX 3090 with corrected ZIL hash, KPAL, ProgPal, and Firo proof of work hash rates, as well as being 10 cents a kilowatt hour. Neoxa is in first place at $277 a day in revenue and $1.98 a day after power. Of course, that is assuming you get that full hash rate with the amount of heat right now. Of course, as we get into the winter months, KPAL will be a much friendlier algorithm. Ethereum at $267 a day in revenue, $1.90 a day after power. In Flux coming in at third at $225 a day in revenue and $1.56 a day after power. Of course, not too dissimilar from the Ravencoin problem of being pretty heat intensive, but as we get into the winter months, you have some of these alternate, more demanding algorithms that you can pop on over to. Conflux at $2.05 a day in revenue at $1.25 a day after power. Xano at $2.02 a day in revenue and $1.23 a day after power. Cero at $1.91 a day in revenue and $1.12 a day after power. Firo at $1.81 a day in revenue at $1.07 a day after power. And Ergo at $1.81 a day in revenue and $1.18 a day after power. We have Vertcoin at $1.71 a day in revenue and $1.11 a day after power. And basically, we got to scroll down really, really far to get to Ethereum Classic, which is $1.43 a day in revenue and 66 cents a day after 10 cents a kilowatt hour. And frankly, I would expect this number to get worse and worse post-merge. We've been talking about this for a while, but I think the people that are running ASICs are basically willing to have a much lower, essentially margin. And this means that it pretty much kicks Ethereum Classic out of the race for GPU miners, unless we end up in a position, of course, where it has some sort of price discovery. Am I expecting a price discovery for Ethereum Classic? There has to be one eventually, because we are going to have a lot more hash rate come onto the network. But with the selling pressure added onto Ethereum during a Ethereum Classic during a bear market, with all of the ASIC miners that are moving over to it, I expect the margins to still be extremely low. Yes, I'm expecting per 100 mega hash to be under $1 a day. That's just what I expect it to be. I think the price of Ethereum Classic will go up as all of these ASICs move over to it, but I think that the selling pressure will be so high that it's going to keep the per 100 mega hash profitability under $1 a day, right? That's pretty much where we're at. Speaking of the networks though, and of course we were talking about the Bitcoin network going up in the hash rate. We are at 244 exahash a second here, and we did have a steep increase in difficulty. So as the temperatures are coming down, we are seeing the hash rate increase on Bitcoin. Is that translated across the whole market? Not really. Ethereum here is still at 942. I don't think we're going to see much more come on with Ethereum, possibly, but not a ton. We have, a slow increase still in the hash rate on Ethereum Classic. It's up to 47.28 terahash a second now. It's a couple terahash up from yesterday. And then kind of drilling down from there, we can take a look at Flux, which was third right now, and it was over 2 mega solutions a day yesterday, or a second yesterday, and it is still today. It did drop below $1 though, even though over the past 7 days it's had a 20% increase in price. It did drop below that. Now, a couple of the other bigger ones, of course, like Ravencoin, that is at 2.8 terahash a second. It's gone down in price 10% over the past 7 days, not dissimilar from, of course, the rest of the market, where pretty much you can say that Flux is kind of an outlier right now at this time. Now, Neoxa, a couple of the, most profitable right now, but of course on still the Kapow algorithm, which is Ravencoin. It is at essentially 604 gigahash a second. I think it's actually a little bit down, maybe like 40 gigahash a second down from yesterday. That being said, the price is up 187% over the past week, and that is putting it at 0.4 of a penny, which is pretty nice to see for the people that have been mining Neoxa early on. And we'll have to see if that maintains. Of course, a lot of that is off the hype of it being the proof of gaming, essentially, where you can game and earn it. Problem is, like with Neoxa, just to be completely frank, is like until there's a reason for the currency to be used in game, I don't see where the demand for the currency comes from. So right now you earn the currency for playing a game, but you don't necessarily use the currency in the game. I think maybe Neoxa Craft will be changing that and adding that in. I'm specifically talking about Rust, but I think you need some sort of demand for the currency to drive that up. And I think once they do, that's going to be a pretty interesting one to take a look at. The other problem that we have is, it has already been attacked, and it could be attacked again because, it does have the algorithm that Ravencoin has. So this is at 604 gigahash a second, but we have terahash a second on Ravencoin, meaning if people decided to hop off of Ravencoin and target specifically Neoxa for another attack, which they have done in the past, it's very easy to do so. And it's clear that they don't have stuff implemented on Neoxa yet at this point to prevent 51% attacks. So that's going to have to be looked at. So that could be the potential double spend problem, which is why right now, obviously after the other attack, they have the way they decided to approach this in particular was to increase the confirmation times to the exchanges. So from an actual network perspective, they didn't implement any fixes. All they did was on the exchange side, basically turn up the amount of confirmations before you can actually have the Neoxa within your exchange. Not dissimilar from what Ethereum Classic did early on when they were under attack from a lot of the Ethereum crowd. And they did implement those high confirmation times. That's why on Ethereum Classic, it can take days on some of these exchanges to get your Ethereum Classic into the exchange. That's not dissimilar from what Neoxa had done initially. That's not a full-time fix. That wasn't the full-time fix for Ethereum Classic either. So Neoxa is going to have to get that fixed, because at the end of the day, it's still there. That potential is still there for the 51% attack. So be careful around that one. And then let's go ahead and take a look at Ergo, one of my favorites. As you guys know, it's been up about 7% over the past 7 days, still staying over $3 a day, which is kind of nice to see. It has dropped below 16 terahash a second to 15.91 terahash a second. And then finally, Caspa, another one of my little favorites here, is at 37.15 terahash a second on the pools and 66.78 terahash a second total, meaning that luckily what's kind of nice is that a lot of people are still solo mining it, and we do have a guide for solo mining it if you want to check it out. Now, the past 7 days it's down about 10%, and it's at basically a third of a penny, 0.3 of a penny. Right now, mining pool profitability over the past 90 days on Ethereum. Crazy pool in first, ZET in second, 2 miners in third. Last 60 days, ZET in first, crazy pool in second, Ethermine in third. Last 30 days, crazy pool in first, Ethermine in second, 2 miners in third. Last 21 days, crazy pool in first, 2 miners in second, Ethermine in third. Last 14 days, crazy pool still killing it in first, flex pool in second, ZET in third. Last 7 days, crazy pool in first, ZET in second, flex pool in third. Last 3 days, crazy pool in first, mining pool up in second, 2 miners in third. And for the last day, crazy pool in first, ZET in second, and flex pool in third. But as soon as I move hash rate over to crazy pool, it'll be in last place for the duration of it. That's just how it works with crazy pool. All right. ASIC miner profitability. You got the Antminer E9 coming up over $50 finally at $54 a day right now, thanks to the increase in price, of course, of Ethereum. Antminer L7, however, dropped down below $20 a day at $19.08 a day on Dogecoin. And if we scroll down a little bit, we got the Gold Shell KD6 at $12.24 a day. Finally back over $10 a day, which is nice, but the KD5 is at $7.30 a day. These are pretty rough numbers for most of these. And the S19 Pro is not looking so good either. It is definitely rough margins at $3.16 a day. Let's get into questions and answers. Be sure to tag at Son of a Tech if you want a response. Super chats are never required, always appreciated first to be answered because they're the easiest to read. And if you would like to support the channel directly, please check the pinned comment in the live chat for the locals page at sonofatech.locals.com, where you can help me survive the bear market if you so wish. But of course, everybody has their own things to deal with right now. So Dave Jack says, you mine any Neoxa? We've done the guide and the tutorial. I don't like Kapow because it's too hot. So no, in particular, I don't mine it at all. That's the way it goes. Like, I'm not going to mine Kapow because it's too hot, man. Perkster says, ask Amatech, hopefully DeFi will branch out into other blockchains. I mean, one of the things that I really like about Ergo is we do have that DeFi ready to go on Spectrum.fi, aka Ergo Dex, and it is available there and is remaining proof of work, which is what makes, me bullish on something like Ergo. It is going to be the only competitor in the DeFi space that remains proof of work. So it's like Ergo or nothing, which is crazy. Like, if for proof of work, DeFi, there's one project, and that's Ergo. There's nothing else. That's crazy. Gabe says, ask Amatech, how does Kapow compare to Equihash for heat? It's absolutely miserable. It's hot, it runs like shit, and it's unreliable. Nick Burns says, ask Amatech, current thoughts on Aneta. I did see they locked up a ton of Aneta, millions of it. I don't have any super I guess huge insights into it, but of course, being one of the first projects on, so we'll just go back to that, right? Ergo's the only proof of work competitor to for DeFi and NFT space. They are. And so why is Neta relevant? Because they will be the first wrapped Bitcoin on Ergo, which means they'll be the first wrapped Bitcoin on a DeFi platform that still supports proof of work. That's it. It's that simple, man. And thanks for being a member for 4 months. Witcherwork says, ask Amatech, if you have less than 32 ETH in weight after the merge, can you combine ETH1 with ETH2 to stake, or does it all need to be ETH1 or all ETH2? What are you even talking about? It's just ETH. Not like really like ETH1 and ETH2. Like even the ETH that people are staking right now is still ETH. Racco says, ask Amatech, hey, last time I talked about GPUshop.org, you said you were not buying GPUs. Would it be a valid strategy to sell inefficient GPUs and buy efficient ones? It depends on how much you get for the inefficient ones, right? And that's really where you're at. And then how you can transfer. Right now, probably not the best because you got 2 weeks left. You might as well use all the hash power you got to mine whatever Ethereum you can for the last 2 weeks, right? I mean, at the end of the day. Knowledge is Power says, ask Amatech, today was my first day back on the jiu-jitsu mats in 2 months and it felt amazing. I can't wait to get back on the mats. Still having some stomach issues. Still needing to sit down a little bit more. I'm happy that we're doing the live streams again. And then I've been kind of looking for jobs as well. William Cooper says, ask Amatech, better use Arbitrum to qualify for their airdrop. Oh, I don't know what you're talking about. My Six Full says, ask Amatech, any chance of a 24-hour stream on the day before the merge? Probably not. At 24-hour streams, I feel sick. I don't stay up for 24 hours. I'm too old for that shit. Molly Prospect or Popescu says, that's Amatech. What about Raven moving to a ET hash algorithm? That'd be a terrible idea. What are you going to do? Take on all the ASICs? I don't think that's a good idea. R2, thanks for the 199 super sticker, boosting that algorithm. Wuchin says, hi, son of a tech. Any further plans on going solar? There's never been plans on going solar. I don't have money for that. Come on. Come on, man. I think the Cabal algorithm could be worked on, but I don't think that you would want to put in, I don't think you would want to go ET hash. That would be a bad idea. Opinions on Crypto Night GPU. No development for it really anymore. You know, the developer, the guy that created it, I used to know him pretty well because we ran the largest pool for them, which was Ryo currency. Seems to be pretty dead on the development front. So, I mean, anything that's utilizing Crypto Night GPUs probably kind of close to dead, if not a dead project. Make sure you guys follow the rules and tag at Son of a Tech to turn the message orange. If it's not, I'm not going to answer it. What time is it too? We still got to do that. It is 11. Okay. Gunmu says, ask Son of a Tech, is your Capal heat NVIDIA's not having issues on AMD? Well, I've definitely had heat issues on the 5700s. It'll just turn off. Yeti Crap says, ask Son of a Tech, just tuning in, give your locals channel a plus, and I'm headed over to upgrade my subscription. Thank you, good sir. Also, if you guys want to head on over to sonofatech.locals, we are trying to hit our membership goal of 800 members. Becoming a member is free, and it'll help you get notifications quicker as well. Rocco says, ask Son of a Tech, hey, last time when I talked about GPU org, you said, didn't you already ask that? Yeah, you did. Samuel says, ask Son of a Tech, are you selling any ETH when the merge hits? I've been kind of just selling it for Ethereum Classic, yeah. Swapping it out. Kevin Stewart, thanks for the $5 super chat, says, how is the Coinbase CEO supposed to get out of the staking business if you can't unstake your Ethereum after the merge? I mean, that's a funny comment, because it's true, right? It's like, well, if they're being censored, I'm going to get out. And it's like, well, you can't get out, you dummy. So, congratulations. I mean, basically, Ethereum moving proof of stake has Ethereum poised to basically be taken over by the U.S. government, because it's clear that the FBI has influenced, Amazon to remove platforms in the past. They could do it again, and being that nobody can remove the stake and they can't easily migrate back to proof of work, you do end up in a position where it is very scary, where basically you're going to have Ethereum, something that's supposed to be like international, and censorship, like, censorless or whatever, in a position where it could just be taken over by the U.S. government. Because it's basically all AWS. Daniel Ring says, that's Son of a Tech, I got my first Octominer style case and was surprised that the fans were in a pull configuration versus a push. Is pull better than push? And it really depends on what side of the case they're on, right? If you only have some that are pushing out and then your GPUs have the fan grill facing away from the fans, then you would want push. If the grill for the GPU is facing the fans, that you would want pull. Octominers come configured in a push configuration by default. Raka says it's a different question. No, that's the same question you asked, whether you should sell inefficient GPUs and buy efficient ones right now. And I said right now, with only 2 weeks to mine Ethereum left, it seems kind of silly to go ahead and sell any GPUs at all. You might as well mine up to that. Because otherwise you're just going to be selling stuff and trying to buy stuff, and you're not going to get any of the full mining capability or capacity that you can have running up. You literally got like 10 days left, bro. Just do it. 10 to 20 days. Somewhere between there. Abnormal Mining says, ask Son of a Tech, have you noticed electrical rate increases when it's time to renew? Mine is due in November, and it's looking like a 30% to 50% increase in electric rates. What they ended up doing on my end is they didn't actually increase the rates of the electricity. They just added an additional fee because I was locked in on a contract. So I kind of am getting really kind of effed over because they aren't giving me a dedicated price. They're just like, oh, we don't know what the fee is going to be. Like at this point, the fee is more than what my actual rate is, right? So last time I calculated it out, it's an additional 8.5 cents a kilowatt hour, where my contracted fee is 5.5 cents a kilowatt hour. So they're manipulating it in really effed up ways. My particular power company. Miller Mining Company says, as son of a tech, what are your thoughts on Flux nodes? Was surprised to learn 1,000 Flux was needed as collateral to get started. No, I mean, there are also Titan nodes that allow you to do less, like 50 Flux, but then you're going to be basically giving your Flux to somebody else that's actually running the node, if that makes sense. As far as Flux nodes, I'm not really a huge fan, like I said in the past, of keeping a majority of one of my like revenue generating things all in one coin. While I like Flux, I think that there's some centralization issues surrounding it as well, and I'm very cautious surrounding it. So, you know, me in particular, I know a lot of people like Flux. I think it's centralized, and I'm very cautious around it. I like the tech. I'm just, you know, call a spade at the end of the day, right? Richard Sullivan says, son of a tech, what are you talking about the AWS? Be more specific. We've talked about this 1,000 times. But if you wanted to essentially see, I'll pull it up for you. I'll pull up the chart. But essentially, AWS is Amazon Web Services, which is basically owned by Amazon, obviously. And which means that they are... essentially, let me see if I can find this. They're in a position where, you know, obviously, like we've talked about before, Amazon deplatformed, you know, and so there's a few things going on. First of all, it's clear the FBI is basically influencing different companies to censor themselves. Or censor certain pieces of content. We saw this as proof most recently with Facebook censoring the Hunter Biden story during the election. In addition to that, we've seen Amazon take down Parler. So this is where the censorship portion comes in. But if we want to actually get into how that impacts Ethereum, over 50% of the actual nodes for proof of stake are run on AWS, meaning that AWS is essentially in control at the end of the day, infrastructure wise, of Ethereum once it moves to proof of stake. There we go. Let me see if I can pull the... It's hard to pull this stuff up live, but that's where you're at. And then we'll talk about where we were running into issues with this on Hetzner as well. Ton being immune to the market drop. Do you think that's because it's not being utilized a lot, Gunmuse? I would think that that's because it's not being utilized a lot, more than likely. Did we talk about it yesterday or day before yesterday? Can you guys help me remember? So much content. I'm sure there'll be a clip too soon as well. Yeah, Zuckerberg literally came out and said the FBI approached them to censor the Hunter Biden story, and they decided to basically adhere to that. So we know for a fact that the FBI does go up and request that things are censored. You can agree with that or disagree with that. That doesn't really matter. What that means is that if you have a platform like AWS that is supposed to be running a network that is censorship less or censorship free, that you have the potential for that to happen. That's just it. Hetzner was yesterday. Thanks. I'm looking for that Hetzner chart. Chart. There we go. If I can find this chart. Trying to catch up on those two guys, but let me try to pull this up real quick. Because understanding how much of the hash rate is on Amazon, and regardless, you would still have to say, even if the government didn't have access, right? Which we've proven now that the government does, or we have reason to believe more than likely, due to the statements from Mark Zuckerberg that essentially the government does have this capability. But even if you didn't, you still have the capability of Amazon censoring at the end of the day, right? So do you want your cryptocurrency to be run on infrastructure that can be censored? I mean, that's really what it comes down to. Too much shit. I don't think it was yesterday. It wasn't. It was day before yesterday. Here we go. Got it. So this is the chart that matters. Right here. All right, so right now this is the chart that matters. This is essentially the chart that shows how much of the current staked Ethereum is on a network, with Amazon being at 52.1%. Hetzner, the second largest, at 16.9%. This was actually due to a story where we are aware that Hetzner is basically making it, they're actually saying you're not allowed to run Ethereum nodes any longer. So they are going to be shutting down this 16.9%, which more than likely will head on over to Amazon, meaning that you will have already Amazon's over 50%, with the move of Hetzner probably going over to Amazon.com. You're probably going to have Amazon at somewhere between 60 and 70% of the entire nodes that are running and powering the Ethereum blockchain. It's not a good thing. So Knowledge is Power was asking about Epcot. Epcot is the controller of all the power. It's not a power company itself, though, if that makes sense. And it's ERCOT, ERCOT. But everything goes through ERCOT, yeah. Village BC says, ask Tech, do you think 20K is where Bitcoin will stabilize around this bear market? I've always said it'll bounce between 18K and 24K through the whole thing. I know a lot of people expect it to go lower, like 10 to 12K. I suppose that could happen. Clearly we're in, or potentially, clearly we're in a recession, in my humble opinion, and we're pretty close to probably going into a depression. So, all the markets could tank, including Bitcoin. All right. Jacob just got some new 3060 Lite hash rate cards, but the unlocker appears to not be working. Running newest drivers in NB Miner 42.2. I haven't had any issues with the 3060 light hash rates not unlocking. That's interesting. Have you tried LOL Miner? John English says, a client's home. Have a great day. See ya, John. I think he's already gone. Ixon Ailes Mining says, at Tech, how do you explain ETC difficulty recent spike scale? Because everybody moved their A10s. All of them got kicked off the network when the DAG went over 5 gigabytes, regardless of if there was 5 gigabytes on them or more on the A10s. They had a bug in the firmware that made all of them get knocked off, and they all moved to Ethereum Classic, thereby increasing the amount of hash rate and thereby increasing the difficulty on the network. Mr. Pixel says, ask Tech for a small 10 GPU miner is powering off the rig post-merge and waiting for everything to shake out a good strategy, or finding a spec coin that nobody's mining and then just kind of doing that. It's really up to you. I have no idea what's going to happen. If I'm losing too much money, I'll just turn it off. If I can go ahead and mine something small that nobody else is aware of for a couple weeks while it shakes out, then I'll do that. If we see massive price discovery on something like Ethereum Classic and it looks profitable, then heck, well, I guess that's what we're going to do. But there's too many variables. Anybody telling you exactly what they think you should do doesn't know themselves, right? So I just going to admit it. I don't know. We have no idea. Price discovery could happen. Sure. Maybe nothing happens, right? As far as like price discovery goes, and you got nothing, and there's nothing to mine, and all the hash rate moves to random networks, I would assume what you end up having is miners, like large miners, just bouncing between different networks until they find something that works, which is going to make all of the networks pretty unstable. If you notice like a hash rate trend, that is possible. That could happen, right? So there could be like a big miner that like moves to Flux first or something like that, and then moves to Ergo. And once they move off of Ergo, you can be reasonably certain they won't move back to Flux because they've already tested it, and you can kind of mine on Flux while they test out their other, options. That sort of stuff may be something you can play with. It's going to be kind of annoying though, I think, at the end of the day. Digital Fortress Mining says, that's time attack instead of the Great Depression, it's the Late Depression. Because they keep delaying it. Look, if they change the definition of the depression, we won't have a depression. Did you ever think about that? Jacob says, Asamatech tried LOL miner with the same results. I don't know then, man. I don't know why it's not unlocking. Other than maybe heat or something like that, I guess, potentially. Kenny Woo says, Asamatech, did you ever consider mining or mined Dogecoin or Litecoin? I'm mining Dogecoin right now, actually, and Litecoin. I'm merge mining them. I have a L3 Plus and an X5 on the network right now. All right, ladies and gentlemen, boys and girls, I'm going to call it today. We stayed a little bit later than normal. I should have the overclock Caspa hash rate video out this afternoon. I'm going to try to at least hit the sauna today and see how I feel in the sauna, and then come back and get that edited and get that up. And then on later this evening, we'll be streaming over on twitch.tv/blindrun, probably updating the Caspa node. So if you've been wondering how to do that, make sure you follow over on twitch.tv/blindrun, where we have been streaming more and more often. I was really tired last night, so I didn't get back on, but we did stream yesterday at least for a little bit too. And I'll see you next Tuesday.